So the purpose of this meeting today is to provide a refresher on the regulatory accounting statement process, its purpose and the process. We want everyone to understand why we do the regulatory accounts. Basically, the sole purpose is to get an accurate record of your actual expenditures, OPEX, CAPEX, against the benchmarks set at the price review, and they all feed into the pricing process. And so Ken Chan, our senior pricing and data analyst, is going to present most of the slides this morning. So he'll take us through the process and reiterate some of these key points. We've also got Rob Turner, who's our expenditure assessment lead, will jump in, and I'll jump in throughout. We've also got other members from the water team joining us today. And Angeline Billas, who most of you will know, she manages our pricing team. She sends her apologies today. She's unable to attend work today. So Ken's going to take us through the slides. Feel free to jump in with questions if you need to. Just raise your digital hand, and we'll take the question. But there's plenty of time at the end for questions and an open discussion. So I'll hand over to you now, Ken, and hopefully everybody get something useful out of this morning. Thank you.
Okay, thank you very much, Chris. Firstly, thank you all very much for lending your time to attend the session on the regulatory accounting statements today. For those who have not known me, my name is Ken, and I work in the pricing and modeling team alongside my colleagues, Angeline, Chris and Rob from expenditure, and other colleagues of ours today in this session. So part of my role here is to ensure that the RAS process, or the regulatory accounting statement process, is coordinated, managed, and completed each year. So generally, today's session is about RAS processes and its key updates that we would like to share with you on the template. And the objective of the session is mainly to discuss the need for regulatory accounts, looking at financial statements and the types of financial statements. What are the processes involved, and how does the RAS impact price submissions? Updates following a review of our own internal processes on ESC's pricing submissions, particularly on the need to comply with the regulatory accounting code, price guidance, as well as expenditure principles. Assist businesses with a monitoring tool. So how can we do that to help businesses monitor actuals versus forecast or benchmarks, and help with a bit of guidelines on capitalization of operating expenses. We then share some examples of key reports following those updates, and give a visual of major timelines and RAS submission on RAS submission processes. And finally, we'll do a Q&A at the end probably, but feel free to jump in during the session as well. So the need for regulatory accounts stems primarily from the preparation of financial statements. So you can see, as an overview, financial statements must be prepared annually by public companies, disclosing entities, companies limited by guarantee. The purpose is to kind of break down and report on essential financial and non-financial information to key stakeholders. Water businesses primarily adhere to the International Financial Reporting Standards, IFRS, rules for consistency. And as you know, the Australian Accounting Standards Board adopted IFRS in 2005, so we maintain that for consistency purposes. Lodgement of financial statements is mandatory for water businesses. So what are the differences between statutory accounts and regulatory accounts? As you know, the statutory accounts is a requirement under the Corporations Act 2001, overseen by ASIC. It's primarily audited by an independent external auditor. It's also audited and approved by the Victorian Auditor General's Office, or VAGO. And the purpose is to ensure that the accounts are free from any material misstatements. Regulatory accounts, on the other hand, is prepared for regulatory purposes according to ESC's Regulatory Accounting Code, and that underpins the whole regulatory accounts. It's audited by ESC's independent auditor. It enables ESC under the Water Industry Regulatory Order, or WIRO, to approve prices for water businesses. And the treatment of accounting principles are different to that of the statutory accounts, which complements the building blocks methodology. So the building blocks methodology, as you know, it's in our price model, and that is under that the RAP accounts complements the methodology of that. How does the RAS impact price submissions? So essentially, it's a process of ensuring that the statutory accounts reconcile to the regulatory accounts, which are then made consistent with the financial or pricing model. So as you can see from a visual flowchart here below, financial statements typically undergo a statutory audit, and as a result, you get the statutory financial outcomes. So for statutory financial outcomes, they're generally cash and non-cash transactions, and the non-cash component of those transactions are things like economic benefits, accruals, provisioning, goodwill, impairment, etc. What the regulatory accounts do is it generally filters through a process of streamlining actual financial outcomes. That is looking mainly at cash or actual transactions of prescribed services. Now, the figures from the regulatory accounts typically flow through the pricing model, and that's reconciled, of course, during price submission, and it's adjusted for inflation as well. And what we get at the end of it is the financial outcomes. So typically matrices like OPEX, CAPEX, and revenue, you will find that in the templates, the key tables, profit and loss, balance sheet, and cash flow are statutory based. So those tables are anchored on a statutory accounts, but we have tweaked that to a regulatory flavor. Again, the focus on that are the OPEX, CAPEX, and revenue, mainly in the key templates that will typically flow through to the pricing model. Latest on the RAS updates. So what I'll do is I'll touch on the first point and pass on to Rob and Chris for the subsequent points. Yeah. So our internal process review of the 23 water price submission denoted a need to kind of align to the regulatory accounts. So basically, we found that there were cash and non-cash transactions submitted during the price review. So I'll expand on that in the later slide. So over to you, Rob.
Thanks, Ken. So touching on Ken's point, there were a few instances where price submission financial models didn't exactly match previously submitted reg accounts. So one of the findings or points we wanted to make going forward for future price reviews, it's really vital for your price submissions and your forecast prices that your initial financial model matches your previously submitted reg accounts for your actual costs and revenues and so forth. It makes our job a lot easier reviewing your price submission, and if fast tracking is an important outcome for your business, this really allows us to move through your price submission far more quickly. I'll let Chris speak to the third point, but that's the key point on that second one.
Thanks, Rob. Just adding to that, in 2023, in the price review, we did get bogged down a lot in quite a few of the regulatory account statement clarifications where what was in the pricing model wasn't consistent with what was in the reg accounts through the period. Businesses were proposing changes to historical numbers or changing the way certain costs were treated. We also had some really weird ones where non-cash items were included in the base OPEX, for example, but then somehow reversed out in the model through some creative use of the model. And it took us months before we were satisfied that all the reg account input data into the models was locked down and consistent. So we don't want to have that experience again. What we've also added into the Primo assessment for the management element is that there's a consistency in the regulatory account treatment through the period. So that's driving home the point that the reg account process is an integral part of the price review process, not just something that gets reconciled once every 5 years when you do your pricing submission. Sort of leading on from that, we think it's really important accurate tracking of performance and actual expenditures against those benchmarks that come out of the price review process. So we'll show you on a couple of slides down the track the new comparison tool that we've added into the regulatory account template, which basically compares your actual figures that you're putting into the model in each year with the inflated benchmark figure for that year. And it shows the differences, the variance. And we really, you'll hear a lot more from us, from the Commission on this point, but tracking performance through the regulatory period we think is critical and helps inform price submissions. We did see again in the last tranche of price reviews, the second round of Primo, that the performance component where businesses are required to reconcile their actuals against their benchmarks and demonstrate, did customers get the value they paid for? I think it's fair to say that some businesses did that a lot better than others, and we'd like everybody to do that really robustly and thoroughly. And a key input into that is that you've got robust assessment and tracking and reconciliation processes throughout the regulatory period. So we'll set up a series of workshops going forward that focus more on that, and we'll invite businesses to speak at that about how you do it, so we can share with all the other businesses best practice, I guess. So more on that later on, but yeah. So that's we'll cover off this tracking insert shortly. So back to you, Ken.
Well, thanks, Chris. So the alignment to the regulatory accounting code. Basically, the regulatory accounting code ensures that the regulatory accounting principles are adhered to when preparing the regulatory accounting statements. So the guiding principles is that we look primarily at actual expenditure. So things like non-cash items are primarily excluded in expenditure, both OPEX and CAPEX. So excludes OPEX, CAPEX provisioning, exclude accruals. Time-based accruals generally are allowed. So things like accruals with purchase order, but longer-term accruals such as long service leave or superannuation accruals typically should not be added in when adding it to your OPEX component of those figures. Economic gains, losses, they're not allowed as well. Goodwill, bad debts, of course, those are kind of estimates, shouldn't be included in to any component of the expenditure. Asset revaluations or impairments, again, as an example, shouldn't be included. Statutory depreciation. Statutory depreciation is included in the profit and loss section of the regulatory accounts, but not in the roll forward tab. So for reporting purposes, we include it as part of the statutory accounts in the P&L. But when we adopt depreciation, depreciation is more of a straight line depreciation and coming from the approved financial decision model. So that's more of a regulatory depreciation. I'll talk on that a bit later on in the subsequent slides. Capitalization of OPEX. So some businesses may have proposed in its price submission to capitalize operating expenses to spread the cost recovery over time or over a longer time frame. So normally businesses must specify any regulatory capitalization of OPEX that was proposed and accepted in the pricing submission in any submission of the regulatory accounts. So put it in, let us know, basically. Businesses must inform the Commission of any new regulatory capitalization of OPEX that was not part of the approved price submission prior to any regulatory account submission. So again, if you have a new or want to capitalize any operating expense that was not approved previously, just let us know, and we'll see how we go. Conversion of IT costs to CapEx are mainly installation, construction, customization, and configuration costs. So we include implementation costs of IT costs, and we allow that to be capitalized. Any ongoings, overheads, maintenance costs, fees, etc., goes to operating expenses. ESC will review any proposed capitalization of operating costs on a case-by-case basis.
And just before we go on to the next slide,
yep.
I just sort of emphasize what we're doing here. So in your price submissions, if you've included and we've agreed in the decision that the capital benchmarks include expense items for the purposes of pricing, we expect the regulatory accounts year by year to reflect that decision. So we're comparing like with like. If you have new costs that you would like to capitalise or propose to capitalise that have come up since the price review, that second point there is saying, have a chat with us. So Rob and I can have a chat and we can give you our view on whether it aligns with the guidance criteria around capitalising expense. So again, this is bringing the reg accounts back to consistency with the pricing price review guidance. So reg account managers, you'll be familiar with the box in the OPEX section of the guidance, which sort of sets out the criteria around capitalising statutory expense items. So please make sure your finance teams or whoever's preparing the reg accounts is familiar with that, and let us know in advance if you're considering capitalising something. We'll look at that like we would in a price review, but effectively it's in advance, and give you our view on that so that the treatment in the reg accounts will be consistent with how you're proposing to treat it in your roll-in at the next price review. Does that make sense? I can't see anyone, but I assume you're all nodding. Yeah.
Just one final point, Chris, before we move on. Chatting to us before you submit the reg accounts, again, it will make the process of reviewing your reg accounts a lot quicker if it comes in at the time with your submitted reg accounts. It'll add some time before we can approve the reg accounts. So yeah, have a chat first. So in this example, in the CapEx tab, there are sections on the explanatory notes. So a lot of water businesses do put in those explanations to us. So it's just a reminder or refresher for those who are new. If you're doing it, please let us know in those sections in the yellow. That can include amortized items, written down values, written down book values,
the commencing year and the years amortized as well. That would be really helpful to us in our review as well. Okay, some of the examples of key reports. As mentioned earlier on, one of the recommendations from our internal review process is to really help businesses monitor against the approved pricing model. So essentially, this is to compare the actuals coming out of the reg accounts to the approved forecasts or benchmarks. So in this example of the benchmark comparison tool that we've developed in the reg account statement summary tab, is that we've come up with, as you can see, the 3 tables. So the tables on the left is the reg accounts summary table. This table primarily extracts out key matrices that will be applied to future price submissions. So things like prescribed revenue, regulatory expenditure, both controllable and non-controllable OPEX, capital expenditure, contributions like such as government and customer contributions, gifted assets and assets disposal. So these are the key matrices that is compiled in the regulatory accounts that typically flow through to a pricing model. And as you can see in the middle table here, that we then take into account those forecasts that has been approved for some of these key matrices and inflate it and adjust it for inflation. And make that comparison. So we have a variance, dollar and percentage terms, and then we can make that comparison. And then I'll let Rob explain the third table on the OPEX tracker.
Yeah, sure. Thanks, Ken. So this third box, this comes back for the reg team, and it's probably one of the only optional boxes in the reg account template, really. And what this third box does is mirrors the price submission financial model methodology for calculating the adjusted baseline controllable operating expenditure in any given year. And so what the business has the ability to do is enter the one-off operating costs that they have in their reg account year in that box, and it'll just sum off the total controllable operating expenditure. And essentially why we've included this is just to allow the business to have a simple and ready way to compare like for like operating expenditures each year that aligns with our financial model. It's purely for your internal use, just as a handy little tracking tool. If, for example, you might have one year throughout the period with high one-off operating costs, whether you've had some reviews conducted or some one-off maintenance expenditure. So that's for your internal use as you use the template.
Okay, there was a question on in the chat. What's the CPI inflation that was used to calculate the 23-24 dollars? Yeah, we used the 23-24 reg year. So for that reg year, we use the latest CPI of 7%. So that throughout remain consistent for that comparison, because the figures that come out from the reg accounts, they are nominal terms in that 23-24 year. So to make that comparison, we use that consistency of the 23-24 CPI.
Which will be the figure that carries through into the pricing model. So we're basically providing you the updated inflation figures that we'll be using. And when we send the template to you, those benchmark figures will be inflated consistent with our official inflation figure.
And adding to that, sorry, Chris, I'll add to that as well, that because this is an annual comparison, we use the March CPI. So typically we apply the March CPI into our pricing model as well. We don't want to have any inconsistencies or stuff like that. So we want to maintain a level of consistency throughout, not only from a price model perspective, but on an annual perspective as well. So we maintain that March quarter CPI into the calculations when we add the inflation in.
Does that answer your question, Glenn? I saw there was a thumbs up appeared there, so hope so.
Yeah, absolutely.
Could I just ask the audience at this point, you've had this tracker in the model that we sent out, what, about a month ago, good few weeks ago. Anyone like to comment on it? Has it been useful, helpful for you? Does it make sense why it's there? I'm getting tumbleweed vibes here.
Cameron, you've got your hand up.
Yeah, thanks. No, I think it's a great addition. So, yeah, thank you for including that. The question I was going to ask, are we going to update that so it'll obviously do the year on year, but also cumulatively over the regulatory period? So you'll be able to see as we sort of progress through this current pricing period?
That's a good question. We'll be doing that in our own data collection system. I'd like to think that each business has got its own processes for doing that. And basically year on year, getting that progressive view of what's happening across the regulatory period against your benchmarks. So the reg account statements is a 1 year snapshot point in time process.
Yep.
We will have our own internal continuum. Hopefully each
We'll do the
business
same, and yep.
we'll
No,
be
that's
doing
fine.
the
No,
same.
yeah, I was trying to
But-
we'll do it in this tool, but no, that makes sense if you're just saying that's the year on year process for it.
Yeah. But again, it's driving home that point that we really see the reg account process as tying directly into the pricing process. So it's coming out of the last price review, so it's tracking how it's playing out in real time, basically, and it feeds into the next price submission template. So it needs to be consistent with pricing approach methodologies and practices. So we're trying to do that. This was our take on how this can look. We're very open to feedback, suggestions on additions. I think turning the reg account statement into a sort of, expanding it beyond the annual year is changing its purpose. But again, if any business has built a really good tracking tool and you're happy to share it with other, I assume it's, a fancy Excel model of some sort or a database sitting behind it generating graphs. But it's the sort of thing that we'd like to encourage sharing across the sector. There's no competition in this regard. What's best practice? What's the easiest way to do this? How do you present, the box on the right there, that variance in OPEX, a difference there, a positive difference there, if nothing else changes, is a price increase at the next price review. Has that been run up the internal review process? Does the executive know? Does the board know that that's what your business is looking at? Is it acceptable? Do you understand the variance? Is it unavoidable, or is it something that's come up that the business needs to respond to mitigate so that it isn't a price increase at the next price review, all else being equal? So this is the real focus, and I think it's the opportunity for each and every business to refine your price submission process and really streamline your submission and your rationale behind it. And as Rob said earlier, make our assessment process really straightforward, because our assessment is verifying what you've put forward. It's not challenging it or looking for faults. We want to verify what you've put forward, but you need to provide the evidence to do that. So really doing this robustly year on year through the period, you're building your story up so that when you put your submission together, you've got that history of why there's variation in OPEX versus benchmark, how the CapEx cumulative has played out across the period. So yeah, building that story across the period is really important. It also means that your business is not dependent on one or two key personnel who understand it to retain all that memory. And then you're vulnerable to losing that if that person is no longer available at your next price review. So we want to see this as business as usual, embedding these price review outcomes into your performance monitoring. Glenn?
Thanks.
Sorry, Cameron, I think I was just building on your point, but yeah,
You
Glenn?
did, yeah, no, that was fine. Thank you.
Yeah, no, I know, Chris, we've had a few chats about this, and we're in the process of trying to finalise our reg accounts at the moment. An interesting observation for me, which is something that we've not focused on a lot, is when you look at your unders and overs against your prescribed controllable OPEX, which is one aspect of it. Obviously, if you're over, that has an impact on debt, but then bringing in the revenue under recovery as well and the impact that has on debt. So one thing I'd like to see going forward is a little bit more detail under the revenue line item at the top, as opposed to being just a bulk number, breaking it down into some of the other line items that sit within the model.
Okay, look, we're really keen to develop this and make it as useful as we can. So, yeah, Ken, we can have further chats, talk about the technicalities in here and what businesses would like to see. So happy to have further discussion on that with you, Glenn, and anyone else who wants to be involved.
Look, I think it's a fantastic addition to the model, and it from my end, it gives the reg accounts a bit more of a purpose as a tracking tool, not just a compliance obligation to meet ESC's requirements.
Definitely. So, Glenn, the prescribed revenue typically, as you know, the benchmarks are obtained from the prescribed section of the model. So the revenue tariff section. So we're looking at the the tariff section and compare against the revenue prescribed section in the revenue tab of sorry, I hope make myself clear. The revenue tab has a prescribed and non-prescribed section, and we typically obtain the prescribed section of the revenue and compare it against the pricing model. Typically compare it against the pricing model of the revenue tariff basket in those sections. Hope that makes a bit of sense.
Yeah, absolutely it does. And I guess all I was thinking is potentially in a future version having a bit more detail as opposed to one line item, breaking it out between sort of res, non-res, Schedule 4, Schedule 2 tariffs, so that we can see where we are, under or over recovering on the revenue side.
Okay, got it. Okay, moving along. The other example of key reports is the roll forward regulatory asset base. So that's pretty common. We have that in the last tab of the reg accounts template. There's no need to fill as of the previous report. What it does, and this is probably a refresher for those who are new as well, we calculate up the opening rep, do the closing rep. So on the left-hand side, you can see the opening asset value. We account for CapEx, capital contributions, both government and customer contributions. That's flown in from the contributions tab in the reg accounts. Depreciation. Here again, we take the straight line depreciation from the approved final decision model and add the depreciation throughout in the calculation of the regulatory asset base. We also include things like asset disposals. And coming back to your point, Glenn, is that we do show up the inflation factor. We use the inflation to calculate up to the latest regulatory account year or in this case, 23-24, for a more consistent real comparison of those figures. So this report is then can be used for a future price submission, and it can use those figures as a definite comparison in that submission later on. So the key tags again are coming from capital expenditure, revenue, and contributions. Okay, to provide a visual of the RAS audit workflow and timeline, we kind of have prepared a process map. And to explain this process map, typically in July, we start the process of completing the regulatory accounting statement templates. So that involves things like period updates, pre-fill data movement, inflation adjustments on the RAP, and we do a bit of quality control on the figures as well. We then, sometime by mid-August, we email the templates out to water businesses, and we hope to get back the templates, the completed templates by end October, early November from water businesses. We'll share that with our regulatory accounts auditor. And in the grade up area is where the auditor will start reviewing, interrogating, reconciling, and preparing the issues log. So there'll be a back and forth correspondence with water businesses until a regulatory auditor is satisfied with the accounts or the figures submitted. The regulatory auditor will then send to the modeling team for another final review of the process. Once the modeling team is satisfied with the review, get back to the regulatory auditor, and the regulatory auditor will then communicate to the water businesses that the reg accounts is approved. The water businesses will then have to get board approval and submit a director's responsibility and board minutes back to the ESC. So that's sometime between December and May subsequent year. So that would actually conclude the regulatory account statement, audit workflow, and timeline process with us. So the key takeaways or the summary. The financial model must reconcile to the reg accounts, which are essentially derived from the audited statutory accounts. The key metrics from the reg accounts flow into the roll forward RAP and the summary tab. The reg accounts are predominantly cash and actual transactions, so the principles of the regulatory accounting code applies. Capitalization of expense items must be clearly stated and have ESC's approval. And the new benchmark tracking tool helps regulatory managers track actual performance against the financial decision benchmarks. It's helped also to understand and mitigate any variances. Clearly explain those variances in future price submissions. And the key timeline for submission is by late October and early November. So essentially, we would like to make the regulatory accounting statement more of a breeding document, a useful tool rather than just a compliance document, as well as just mentioned earlier on. Yeah, if there are any questions or feedback, Chris, over to you.
Thanks, Ken. You can probably stop screen sharing now if you like, and happy to respond to any comments or questions from everyone here today. Any questions at all?
I think you're getting tumbleweeds again, Chris.
I might jump in with one if I could, guys.
Daniel, how you going?
Very well, thank you. Sorry I didn't get the uniform memo. You've all got blue shirts on. Where's mine?
Yeah, that wasn't organised. It was just a fluke.
Well, you guys look all on point. And I think Keen and I discussed this to death last year, but on the wording and the instructions around the non-cash and the accrual sort of basis there, I think it could be really helpful for people coming in if that sort of the definitions behind those were beefed up a little bit, or some of the naming conventions was changed, because it does, like my background's chartered accountancy, it does clash quite significantly with those definitions. And I appreciate they're two different sort of regulations for accounting, being, you know, statutory versus regulatory, but like the sort of stuff, non-cash and accrual, they're like fundamental accounting concepts. And when we're sort of talking about them, we're not necessarily applying them in the same way, or like quite differently, it can be a little confusing to new people coming into it. So more of a statement than a question, but I'm interested on your thoughts there, or anyone else who had sort of similar trouble with that.
I think we can agree with your statement. It is a different line of thinking. I'll throw to Ken in a sec, but look, my understanding as a non-accounting person is that the reg account, the reconciliation with the stat accounts, is identifying those key differences, so that the reg account figures are what goes into the pricing model, and it identifies where it differs from the stat accounts. Yeah, Ken?
Yeah, that's correct, Chris. We had a couple of workshops with our regulatory auditor, who's obviously a qualified chartered accountant as well, to come up with the wordings in the guidelines. So we had this workshop with him and stated as accurately as possible from a regulatory perspective of the terminology that was involved, and that's why we put those terminology into the guidelines.
Yeah, and I appreciate they do come from
accrual,
in the water accounting code as well. But yeah, it's like just a breeding ground for confusion without a really solid explanation behind it. If we are going to stick with those naming conventions, like that's fine, and they are in the water accounting code, so that's okay. But the explanation and description behind them, I appreciate we can talk about them here and you and I can sit on the phone and learn about them. But for new people coming in, like the chances of people putting the wrong things in, I reckon, are really high. And you guys might not necessarily know, because they won't know to call them out.
Yeah. So I think what's becoming very clear is that this is not an accounting process in a purely accounting process, and it's not purely a regulatory process, but it requires within a business the regulatory team who's familiar with the decisions that were made as part of the pricing model, and the accounting team to work together to make sure that it lines up. That's no what we're looking for. And that way we're not trying to do that reconciliation or work out where those differences are during the price review. They should be taken care of before the submissions come in. That's what the ideal is. So yeah, it does require understanding of the differences between regulatory accounting and the statutory accounting. But that's what the reg account statements are doing, is identifying those differences.
But if you get a reg person who then goes to their finance team and says, hey, can you pull out all the non-cash items, you're going to get a completely different set of numbers compared, like, on that accounting person's understanding compared to what you actually want.
So good luck sorting all that out internally. But
I can handle it, because I have the both, but it's I just worry for people coming on and sort of how it goes in the future.
Yeah, which is why we're running today's session. It's kind of identifying these issues. It might not solve them, but it certainly flags that these are issues each business needs to be well and truly on top of and have processes to manage clearly. Because the the final figures that get accepted in the reg accounts. Now, when we accept them, it doesn't mean that we've verified every line item was correctly treated, but we're saying that's the figure that we're accepting. That flows through into your forecast expenditure, particularly with OPEX. So that the baseline year OPEX becomes a key part of the forecast for everyone who's familiar with the pricing model. So that figure should reflect your actual regulatory costs, not other costs, because it flows through into prices. So our role with the Commission is to make sure customers don't pay more than they need to receive the valued services from their water business. Part of it is making sure that these numbers that are presented as each business's required operating cost is actually that cost. So it's really important that there's a good understanding between the finance team and the reg team of these differences and getting the regulatory statements correct. But really good point, Daniel. And it's not, I'm not sure if Jarwid's here today and Ken, but these people that come in with statutory accounting experience and then have to get their head around regulatory accounting. And so my understanding as a complete accounting novice is that that's not a simple thing to do. You've been trained to think a certain way, and now you're being asked to think slightly different in some regards. So, but it's important that we do understand that. Okay, so Jarwid's not here. So I think it's an eye-opener. It can be a real eye-opener for accountants, is my understanding.
No, it definitely was a change-up.
Yep.
Then we can also take it offline to see what those items are, and we can take your comment as well.
I'm good with them now. Like we did it to death last year, Ken, and as much as I enjoyed chatting to you, I don't think we need to do it again. But my comments more generally and for the industry and for other people in this room and people who will be in this room in future years, like if we can have those descriptions and differences more clearly articulated, I think it'll go a long way to improving the process. And, Chris said to make sure the prices customers pay are the lowest possible in the end and the most accurate and properly represented.
Yep. Thanks, Daniel. Nitin?
Yeah, I had a question regarding the OPEX point that was presented below and before, on the slide pack, that if any OPEX has changed, during the course after the pricing submission has happened, to inform what the changes have been. How frequent is that? Should that be yearly, or should it be as soon as we are aware of those changes, or is there any particular frequency you'd like that?
Yeah, so if there's the point was more to if there's a new cost which the business might think meets the guidance criteria for being capitalized, and it's a statutory operating expenditure, come and talk to us as you're preparing your reg accounts before you submit it to make sure that treatment would be appropriate. Right. If there's a change in accounting standards to an existing cost, and you think that might change how it's reported through the reg account statement from an operating expenditure to a capital expenditure, come talk to us as soon as you think that might be the case.
Well, what we're looking for is consistency in how you treat it in your reg accounts with how you're going to treat it in your price submission. So if the business is thinking it's going to propose to capitalise a new expense that's coming up, chat to us about it, explain why, and we can kind of give it the scrutiny that we would do if it was in your pricing submission. But ideally it's done beforehand, and then your reg accounts are treating it that way up to the price submission. Does that make sense?
Yeah, it does. I'm just thinking of aligning it to sometimes organizational strategy, and sometimes strategy is not clear, and the timing of the submission of regulatory accounts and the decisions does not necessarily match. But I think I get the point that to inform as soon as practicable. Yeah.
Well, that's only for costs that have come up since the pricing decision.
Yeah, that's right.
That you would like to consider capitalising. So yeah, there's a new software project that you're embarking on that you have to do during the period. you would like to capitalise the project development and implementation costs, even though they'll be a statutory expense item, have a chat to us about it. Let us know that's your intention. We'll tell you whether we think it meets the criteria for capitalising for pricing purposes, and then we'll look for it when the reg accounts come in. And then we'll expect your pricing submission model to line up with that, not be changing things. Yeah, we don't want to see when the pricing model comes in, these things that we expensed 3 years ago, we now like to roll into the RAB. So we're just looking for consistency throughout the period so that when we come to do the price review, that consistency is there. Makes a huge difference for us and also for you, for each business, if we don't have to unpack these anomalies that show up at the price review.
Yeah, makes sense. Thank you.
No worries. Anyone else? Got a few minutes left if there's any other questions or comments. All right. Ken or Rob, any sort of closing comments before we wrap up?
No, I think we've covered a lot of ground and hit the key points we wanted to. Just reiterate, if there is a change or a new proposal to capitalise an operating expense, get it in beforehand, and just reiterate the purpose of the regulatory accounts. It is actually key input into your price submissions, so alignment is key. I think that's probably the 2 points I wanted to touch on.
Thanks, Rob. Ken?
Similar to what Rob said, we just want to make the reg accounts a more user-friendly tool, just not a compliance file that you've submit and it's tucked away, so that everybody can apply the information from the reg accounts data and hopefully help with the tracking of the information.
Very good. All right. Well, look, thanks, everyone. I really want to thank you again for coming along this morning, making the time. Hopefully it's been helpful. Hopefully it's useful. We're very happy to take further questions or follow-up discussion. If you have any, just reach out to Ken or Rob or myself or just the water inbox, and someone will get back to you. Picking up Glenn's point that there are probably more opportunities to add to the regulatory accounting statement template without changing the core part of it, but these add-ons that make it more useful and actually a tool for each business. Thanks, Ken, for presenting this morning. Really informative, great slides. We'll send the slide pack and the link to the recording to everybody afterwards. Thanks, Rob, for your input, and thanks for the questions. And we wish you all the best with your reg accounts this year. May it be smooth and seamless. Thanks, everyone.
Counting.
Thank you.
Thanks, Byle.